So what about this? A lot of people this generation is getting into cryptocurrency, getting there, making some money, and then they're bouncing in like 6 months.
Exactly.
Do they pay capital gains tax on that as well?
Do you then want people to love you the way that all the hoe girls love you? Because they come
the
at you.
hoe girls. Ooh.
Welcome to the Singles Mansion, first edition, first season.
Whoa!
But I think that's gonna stick with them.
That's crazy.
Just because you're talking loud,
I
don't
want
make
to know,
it.
is it nothing or is it something?
Look,
What's happening? No cap. We with AO, about to get a play. Oh, pull up to the table. Let's go.
Yo, what's going on, fam? It's your boy Anthony Neal. Welcome back to the table, the ATL edition. That's right. I am really excited about today's show. It's going to be short, sweet, simple, straight to the point because it's tax season. And so I wanted to make sure during this time, I presented to you all an expert who is my expert. She is filing my taxes this year. She's been coaching me along this new journey as being a full-time entrepreneur. God has been a blessing to the company, and she's been guiding me along this journey. And so I said, yo, I need you to come back on the show. Y'all met her last year, the People CPA, AKA my CPA. She's gonna come back and just really give us some wisdom. If you're a W-2 employee, what are some things you should be doing? If you have your own business, what are some things you should be doing? If you are a W-2 employee and you have your own business on the side, what is it you should be doing? And we're just getting straight to the point. So, y'all already know her. I don't need to introduce her to you all. She's the People CPA, AKA Anthony CPA. Welcome back to the table here in ATL. My sister. What's going on, fam?
Hello, everyone. Thank you, Anthony, for having me here at the table ATL edition.
Yes. And tell them, everyone, your legal names. They can look you up on social media.
Yes.
Up front.
Yes.
Don't give them your full name, because I want them looking for your address and stuff like that.
Okay, so my name is Sheneya. I'm a CPA, born and raised in the Bronx, New York. I have my CPA license in the state of New York, and I'm the founder and CEO of Fuller Financial, which is an accounting firm dedicated to helping creatives, entrepreneurs, small business owners, and affluent professionals with navigating their financial journeys.
That's right. And she's been a blessing to my life, man, over this last year. So let's get to it. It's tax season. All right. Off the rip. The people watching us right now are ready to file taxes. They are ready to go get their tax refund. They're going to jump out there and go do it. What are some things that they need to be putting into place right now? One, to make sure that they maximize on their deductions, but two, they're doing it legally and ethically.
Yes, heavy on legal and ethical. So I want to start by categorizing individuals into two groups.
Okay.
We have those that are earning traditional income, so we call our ordinary income earners. Okay. And then we have those that earn income via portfolio or passive income, right? Because all of these dictate what deduction you should be looking for as you are filing your return. If you are an ordinary income earner, in regards to what refund you get, this is all dependent upon how much taxes you pay in through the year and also what deduction and credits that you get. So if you are a W-2 employee, one way that you can maximize your tax position is by having proper withholding. Mm-hmm. So whenever we get hired into a new job, we're filling out a W-4. That W-4 form tells the IRS how much you want to have withheld from your checks. Okay. So the more you put, the less you have withheld. The less you put, the more you have withheld.
What do you recommend?
You want to actually, there's a W-4 calculator that's on the IRS.gov website. That's free. Okay. So if you are unsure and you can't get in contact with a CPA, you can use the IRS.gov's tool, and it'll let you know how much you should put as for your withholdings. Okay. Typically, you put one for yourself if you have no dependents. If you have a dependent, you now start adding. So if I have one dependent, now I'm going to put 2. If I have 3 dependents, I'm going to put 4. Okay. If you are married and you are the sole provider, you can put 2 because technically your spouse is kind of your dependent. Okay. You want to have less taxes withheld so you can have more income in your pocket so you can take care of your family. Yes. So it all depends on your filing status.
Okay. So what about those people who go in there and put like 15?
Those be the same people that owe. They be like, oh, how come I owe? And I'm like, let me see your W-4. And I'm looking, it's like 10. And I'm like, you don't have no kids. You don't take care of your parents. You don't have no dependents. Why'd you put 10? They're like, oh, well, somebody told me that I'll have more money in my pockets throughout the year. Right. And again, there's that, the weight of, okay, yes, you can have money in your pockets throughout the year, but come tax season, you may now owe because you did not have an adequate amount of withholding.
So is there a way to where we can narrow it down to where maybe by the end of the year, we get a little return to no return to where we do just break even?
That is the goal. That is every taxpayer's, that should be their optimal goal, because think about overpaying the IRS and getting a big refund is that you're not getting any interest on
Talk
that. To
me now.
You're not getting any interest. So you get this big refund, yes, but again, it's money that you could have had in your pockets last year.
Yeah.
Could have took that same amount, invested it into a mutual fund, and made 10% off of it. Okay. But yet you're waiting for tax season to get back something that has no interest attached to it.
I told y'all. See the people CPA. The people CPA. CPA. All right. So now keep going, because this is really gonna be all you. Like I just want you to just really help the people, teach the people what they need to be doing, because I think right now they want to get the most they can back from taxes. So how do we help people get the most back?
Yes. So in regards to getting the most back, again, that's not the goal. Our goal is to hopefully break even.
Thank you for checking me on that.
Yeah, it's not checking you. It's advising. It's what I'm here for. Right. So this is when the taxpayer wants to take control of their financial life. Okay. So many taxpayers are just paying into the system and they don't know how it works, right? So you want to at least assess your financial position every quarter at a minimum, to where you're looking at how you're earning income. Are you earning income just from your W-2? Are you earning income through a business? Are you earning income through investments? Are you earning income through somebody else's business, right? So you want to assess this, because if these factors now change, you may be triggering additional tax liabilities, because aside from additional income tax on your ordinary income, you may be subject to capital gains tax. You may be subject to, tax on self-employment. You may be subject to taxes for underpayment if you were supposed to pay and you now owe. Okay. So you want to make sure that you are on track. So if you're somebody, and I typically tell taxpayers, if you trigger schedules A, B, C, D, or E, you want to go ahead and get a CPA to assist you with your tax filing. Okay. Yes. Okay.
So break this down. You said capital gains tax. I think some people may be wondering, okay, what does she mean by capital gains tax? What is that? And how do you know you either have to pay capital gains or you don't have to pay capital gains?
Yeah. So a capital gains transaction is triggered when a taxpayer sells an asset for more than its original purchase value.
Okay. So if I bought it for $500,000 and I sold it for $600,000, I have to pay capital gains tax on that $100,000.
Exactly. And now the thing about capital gains tax is, depending on how long you held that asset, you may either fall into paying short-term capital gains or long-term capital gains. Okay. In the long term, most things are typically a lot more favorable. Yeah. In the short term, your capital gains are going to be taxed at your ordinary income tax rate. For this year, thus far, granted, nothing changes with the new tax proposals. Right. That ordinary income bracket is 0 to 37%.
37%?
37%. Exactly. So imagine if you made $800,000 in investment income, you're going to pay 37% taxes on that.
That's short term?
That's short term, yes.
So you mean a house that
up to 37%?
I'm going to be taxed up to 37%.
No, so there's exclusions. So I'll get into that after I talk about the long term. Okay. So in the long term, capital gains are either taxed at 0, 15, or 20%. Zero. And this is dependent upon your income. Okay. So if you earn, let's say, less than $30,000, you can pay $0 in capital gains tax.
For real?
Yes. If you earn anywhere between, let's say, 30 to $400K, you're paying 15%. Okay. And if you earn even more than that, and again, these thresholds may not be completely accurate, it's coming from my head. But if you earn more than that amount, you're now paying 20%. So even at a maximum, you're cutting your tax liability at least by 17% by holding your investment for more than 1 year.
Okay. Is it 1 year? You're the professional. I just study money too. I thought it was 2 years. What does a 2 year come into play?
So that's different. So what you're referring to is real estate.
Yeah,
right?
yeah,
Exactly.
yeah.
So remember, capital assets are different because a capital asset can be machinery, it can be equipment, it can be a car, a vehicle,
Okay.
it can be a business. A business is an asset as well.
Okay, so what about this? A lot of people this generation is getting into cryptocurrency, getting
Yep.
there, making some money, and then they're bouncing in like 6 months.
Exactly.
Do they pay capital gains tax on that as well?
Yes, they are supposed to pay.
Why you say supposed to? 'Cause
The
people
thing
ain't
about
paying?
crypto is because it's this new thing still, there's not a lot of regulations as with traditional brokerage accounts.
Okay.
Traditionally, if you invest in the stock market, you're going to get a form 1099-B at the end of the year that shows your interest, your dividends, your capital gains, etc. Thing about a decentralized currency is that the transparency is not there. So yes, you want to be encouraging taxpayers to properly report this income,
Right.
So that they, won't be, questioned for tax evasion in the future, if they do figure out a way to track this type of income. But you want to go ahead and encourage people to, again, be legal and ethical and
Yes.
report how much they earn.
Legal and ethical.
Yes.
That's what we promote over here.
Yes.
That's why she's my CPA.
The good thing about reported income, because people are like, well, why would I report it if I don't got to pay tax on it? Well, it depends on if you are playing this game for the short term and the long term.
Okay.
Because in the long term, claiming $600K and gains from being a crypto investor is amazing, right?
Right.
Because you can now leverage your income to get personal lines of credit, business lines of credit. You can get mortgage. You can continue to work on your wealth building journey.
Yeah.
Aside from not reporting income and you look poor on paper, well, guess what? If you're trying to come to me for some type of funding assistance or with a business idea and you look poor on paper, you're not probably going to get through.
Yeah, that's true.
Exactly.
She's still my CPA. I know y'all saying she said lines of credit. Well, when she advises me, she knows I only do cash.
Yes.
She knows that. But you did direct me on how to set up my taxes to set myself up to get my new mortgage.
Exactly.
And that's what I love about it. You know what I'm saying? She's still my.
Yes, we customize. Listen,
Absolutely.
for
I mean,
each
you gotta do
client.
it for every client. I feel you,
Exactly. We
So,
customize because we want to make sure, again, it's all about your personal financial journey.
Absolutely.
And our journeys may all look different.
Absolutely. Cash.
He just got money, y'all. He can cash out on everything.
Listen, God has been good. I'm not gonna lie to you.
Amen.
2021 was a great year for me, and I'm looking forward to seeing what God's gonna do in 2022. So, okay, cool. Let's do this. A lot of people right now are going to, I promote a smart tax. Smart taxes, no hidden fees, and they are killing the game, right? And I think they're like anywhere between 10 to maybe 20, $30. Don't quote me exactly. I'll put their link in the show description below. And then you also said too, if you make less money, not as much money, there's a website you can go to that actually they will volunteer to help you out for free.
Exactly. So you guys should always know that the IRS does have resources for taxpayers.
Yeah.
One of those resources is actually what got me into the tax game now. It's a program called VITA.
Okay.
It stands for the Volunteer Income Tax Assistance Program. It's a free program via the IRS where they are in partnership with third-party companies to help provide tax preparation services in low-income communities.
Okay.
So depending upon where you are, you want to go and check out the irs.gov website.
Yeah.
Search for VITA and find a location that's near you because it's free
And it's 100%
and it's getting
free.
done by a person. So you kind of feel a little bit more comfortable, like I didn't have to do it myself.
Got you. So this is what I'll do. I'll make sure to drop in the show notes Smart Tax. It's they're very, very affordable. I've used them in the past before, and they've partnered with, not partnered, it's owned by Dave Ramsey, my mentor, which is very, very solid. And then if you are in that low income community, let's say $15 for you is a stretch. Let's be honest. There are people who are doing that, who need some help. I'm gonna put VITA as well down there. I'll find that link, put it in the show description for you. So for business owners, right? Why is it important for them to have someone like you, not just for this season to just file the paperwork, but I pay you for the whole year.
Right.
And she's not cheap. Now, she's not
You ain't cheap either, Anthony.
Yo, my girl is not cheap. But she ain't crazy though, because you have saved me a lot of money. Every major move that I do right now, from bringing on a new team member, from she told me how to save myself in taxes last year. I won't say what I did, but she's like, hey, you need to go do this. I have learned so much from having as a self-employed person. Because does a full-time W-2 making $60,000 a year individual need a full-time CPA like yourself?
So I wouldn't say full-time unless, again, they are triggering these schedules. So schedule A, B, C, D, and E.
Okay.
When you're filing a 1040, which is your individual return, you typically have schedules attached to it, which separates out how you earn income or how you expense. So schedule A is your itemizable deductions. That means you pay a lot in medical expenses, dental. You also have real estate property for your personal. So you're paying property taxes, you're paying real estate taxes. That's schedule A. Schedule B, you earn interest and dividends. So now that means you got a stock account. You got some assets somewhere.
Yeah.
Schedule C, that's specifically for a self-employed business.
Yeah.
Schedule D, that's capital gains.
Yeah.
And then schedule E is real estate. Yes, rent and royalties.
Oh.
Yes. So once you trigger those as an individual, I would say to consult with the CPA.
If you sell a house, that's a Schedule E, or is that just a regular taxes?
So it depends on how you sold the house,
It's
right?
my primary house.
If it's your primary property, you now have a couple of options because you do get favorable tax treatment for having even owned your asset. They will allow you to exclude your gain, which is amazing. So imagine if you had your personal asset for 2 years out of the past 5-year period, you will now qualify for a homeowner's exclusion.
Gotcha.
So you don't have to worry about paying capital gains tax. So that's one way to avoid with real estate.
Yeah.
Another way to avoid paying a lot of taxes in real estate is to do what we call a 1031 exchange, where rather than cashing out on your investment, you take that profit, roll it into another property of equal or more value, and now you get to exclude that gain.
And that's on rental property only, right?
So
Investment property.
Investment properties, exactly.
Because we tried to do that for my primary, and you was like, we can't.
We can't. So if it has to be either investment, because for your primary, your option would have been to qualify for the 2 out of 5 and exclude the amount.
I was so bummed.
But now you know the next time you own a house, let me stay for 2 years.
All right. Before we get to the self-employed people, what are like 3 deductions legally and ethically that W-2 employees can write off that some tend to maybe forget about or not get advised to do?
Oh, of course, there's a bunch. Okay, so I guess I can do 3. Number 1 is your retirement savings. If you are contributing to traditional retirement accounts, you do get a tax benefit for that. Wow. So make sure you are deducting now your tax return.
Yep.
Number 2, a lot of us pay for not us, I don't have kids yet, but a lot of taxpayers, have dependents, they're paying for a child and dependent care. Even if you're paying your aunt or your grandma to take care of your child, if that person is going to allow you to report their social and the amount that they're paying on your return, you can also deduct your child and dependent care expenses.
Oh, because they will pay them. Taxes. Exactly,
because now you're creating a transaction to where you paid the person for child and dependent care, but they are now a self-employed individual.
Oh,
exactly.
Snap.
So in this way, they get some income to report because hopefully they can deduct against it.
Right.
And then on you get to deduct the child and dependent care expenses on your return.
So you trying to tell me people who hire, like if I hired Rebecca, she's like 20 years old. She does all my social media, right? I'm just playing. She's not 20. She's a grown woman. But if she came over to my house, watched my kids, and I gave her, let's say throughout the whole year, $1,000, I can deduct that $1,000 on my taxes as long as I report her social?
Exactly. So you'll add it into the child and dependent care worksheet where she'll add her social. If she has a business, because some people do have businesses for this, or DBAs or EIN numbers.
Yeah.
You'll add that, the address, and how the relationship between her and the child went. And yes, it's now deduction. So your child and dependent care expenses are deductible.
Do you see why she the people CPA? Because she for the people. What? I did not know that. Okay, hit me with another one.
So another one for my teachers out there.
Don't go there.
If you are a teacher, teachers get a special above the line deduction where they can deduct the cost of, paying for supplies, pencils, pens, chalkboard as well. That above the line, I think the deduction limit is $250.
Wow.
So, and that you get that regardless. So as long as a lot of teachers that we know, they buy chalkboards, they're buying markers, they're buying stuff, they can deduct those expenses on their tax return as well.
I know the answer to this, but I want you to say this. Because again, I want to help people do things legally and ethically and not get into any trouble. A lot of people think they can write off their miles going to work.
Oh.
Yeah, like, well, I'm going to work and it's not, it is for work.
Yeah.
So, I mean, I know I've had other people filing my taxes. I mean, well, how many miles did you drive to work this year?
Yeah.
So I'm like, a lot. What are you talking about? Well, we can write it off. It's for work.
Yeah.
And I was like, you know what I do, right? But that's not legal, is it?
It's not. So tax laws change, throughout the year. It always changes, especially when we have a change in government. And back in the day, it used to be an itemizable deduction for you to deduct unreimbursed expenses from you being an employee.
Yep.
So that's where
it comes
came.
from.
Exactly. But again, you choose an expert or somebody who's just doing things. An expert, because I'm a CPA, I'm required to do CE credits. So I'm learning about tax law changes.
Yeah.
They got rid of that.
They did.
Yes, 2018 TCJA Act. Right after that, no more.
No
more.
So people out here misleading people.
Yes, because you can only deduct, if you are an individual, you still can deduct charitable miles. So if you're driving to and from charitable purposes to, contribute your time, that's deductible.
Okay.
But you cannot deduct mileage unless it's now for business purposes.
Okay.
Right? So we can transition into, self-employed individuals where there's a plethora of things that you can deduct.
So let's say we have generous people who are watching right now. I have a very generous tribe. They give a lot, like to church, for their tithes, offerings. They help pay for youth pastor salaries. They give to the Boys and Girls Club. Once a year, for myself, when I was a W-2 employee, I used to actually give away like $5,000, $10,000 to homeless people to put them in a hotel for Christmas time, right? Does it look odd when you are so generous? Let's say you give away 25% of your net pay to tithe, offerings, and to just being generous. Does it look odd when you file taxes that you gave away that much money?
So no, because again, it's all personal preference. So as long as we can support the deductions, that's what we're looking for.
Okay.
The thing about donating in that way, when it's not going through a IRS recognized 501c3, is that deductibility is not equivalent.
Okay.
So in order to properly deduct, you want to make sure that you are contributing through a not-for-profit organization. And I can't even just say not-for-profit, specifically it has to be 501c3. Yes. This way, again, they recognize as tax exempt, so your donations are tax deductible.
Yeah. That's good. That's good because my a person who filed my taxes, I want to be careful because now since I have you, there's a difference between a CPA and someone who just files your taxes.
Exactly.
And so the person who was filing my taxes told me, because you gave it generously, we can write it off. And then when I talked to a tax advisor, he said, no, you can't.
Right.
You didn't give it to a 501c3.
Exactly.
So then he told me, stop going and just putting the money into the hotel and giving them the food. Partner with the organization that is 501c3 and have them do all the work so that way you can legally write it off.
Exactly. And that's a tax planning strategy right there.
Absolutely.
That's amazing.
That's why you on my payroll.
Do you then want people to love you the way that all the hoe girls love you? Because they come
Not the
at you.
whole girls. Ooh.
Welcome to the Singles Mansion, first edition, first season.
Whoa!
But I think that's gonna stick with them.
That's crazy.
Just because you're talking loud,
I
don't
want
make
to know,
it.
is it nothing or is it simple?
Look, can
Yo, what's going on, fam? It's your boy, Anthony Neal. Welcome back to the show. Man, listen, we are having just a real good, quick conversation with the People CPA, my CPA, and she's just dropping some knowledge on what should you be doing right now to prepare to file your taxes, and not just file your taxes for today, but I love her strategy, and it's a strategy that I teach. How do we prepare ourselves to pay less in taxes so we can keep the most of our money, and towards the end of the year or towards this time next year, how do we pay the IRS little to nothing? How do we get close to even to where we can enjoy our money. Because I'm tired of paying the IRS money and then they don't give me no interest back. But then the moment you keep money from them, it's not just interest, it's also penalties.
Exactly.
You know, so I wish I could charge some penalties, interest, issues, law fee. I want to charge them
Everything, agony.
everything, you know what I'm saying? But real quick, before we get back to the people's CPA, real quick, don't forget, right now, a lot of you all are going to be getting a lot of money to come back from your returns. And that's cool. That's great. I want to encourage you to build your emergency fund. I want to tell you where to park your emergency fund. And that's what my friends over at Prize Pool. They're going to give you 0.30% on the interest rate. It's going to be FDIC insured. And then also, if you just park your money in the account, they're going to give you a ticket. So let's say if you have $1,000 in there, they're going to give you 1,000 tickets to go towards weekly and monthly grand prizes. So not only are you going to get a higher interest rate, because the average bank is giving you like 0.05, they're going to give you 0.30. And plus, they're going to also give you an opportunity to win an extra $100 up to about $25,000, depending on what their grand prize is. I've already won about $300. I parked my money over there. Come join me over at Prize Pool. The information is in the show description. When you get your money back this year, save a little of it, okay? Invest a little bit of it. And then also, stop trying to, this is what I do hate. People say, well, I do that with my taxes because that's my savings account.
But as you just said, you don't get no interest. So what is it? If that's the case, you could have just put your money under your pillow.
Because they're like out of sight, out of mind. What?
Right. And outside of not getting interest, remember, you also lost even more because of inflation.
Oh my God.
Right. So that opportunity cost, though it doesn't seem like a lot, it can be substantially a lot. Because imagine taking that $6,000 you got for a refund, but instead of getting a refund, you actually contribute to a Roth IRA, all last year for that $6,000 to where you broke even.
Yeah.
At the end of the year, that Roth IRA will probably, hopefully, be worth more than that $6,000, right?
Teaching good.
And in 15, 20 years, it's probably going to be worth $100,000.
Right.
So you want to be able to understand that opportunity cost is a real thing. And though you get the money back, it's the fact that you actually are getting a little bit less because inflation, right?
Come on. Mm-hmm. Listen. Okay, listen. I'm going to drop Ramsey's smart tax information below, VITA information below. I'm also going to drop her information below because if you are self-employed and you're going through all those forms, you do need some help, and she's a great person. She does all of my stuff. And I'm telling you right now, I got to cut a check back. I'll just be honest to the IRS. I'm going to pay them on due date. On due date. Okay. And they're not going to get the money before. They will get it on the day of. It'll be posted on the day of due dates. For the self-employed people, one of the things that I've really been strategically asking you is, how do I know how much to write off without hurting myself from potentially having to show income? So that way, when I purchase my new home, it didn't hurt me. Like, what's a good gauge?
Right. And that's the thing, because you mentioned earlier that unlike, most relationships, we don't just meet once a year. Right. I'm in your business all year.
Right.
How do you know what's going on so I can better serve you, better direct you, better advise you? And this is another piece of that, right? So understanding that come tax season, we should be prepared. Yeah. We should know how much we're on track to pay so that when the time gets here, we already know what's up.
Surprise.
We know what's up. So for self-employed individuals, they definitely need that assistance.
Yeah.
You don't want to be a self-employed individual and you get to January 1st of the new year and you did not learn, or more importantly, you did not execute any tax strategy.
Yes.
Right? Because now you're putting yourself in a very tight position. After the cutoff date, which is 12/31, or whatever your year end is, if you change to elect a different year end, that's your cutoff date,
right,
for the most part. So all of our many deductions that we can take, we're now limited to just a few because we're now in a new year. We're in a new tax year. Right. So we want to be proactive in tax plan. Yeah. For individuals that have businesses, know that there's no cap on what you can deduct. Right. Yeah. So if you want to take it to the extreme, you can. You can go ahead and deduct pretty much almost anything. In our first episode, we talked about how to deduct an expense, all it needs to qualify is being ordinary and necessary, meaning that it's ordinary in your course of business, right? I'm an accountant, so buying software, buying laptops, that's ordinary. Necessary, meaning that I needed that to make money. Again, my laptop, my software, I need that, right? I need that. That makes the expense deductible, right? But of course, getting carried away can be very easy because, again, you have a good CPA on your team, we can make almost anything deductible ethically and legally, right? If we turn it into a proper business expense.
Yes.
However, you don't want to get too crazy with deducting if you know that you need your AGI. So AGI is your adjusted gross income.
I know that. I knew that.
Yes, your adjusted gross income. That is your magical tax number. That number is tagged if you're applying for almost anything. They're asking for your AGI. If you OD on deductions, your AGI is going to be a reflection of ODing on deductions.
Right.
That can now hinder you again if your goal is to purchase a home, purchase a vehicle, whatever it may be. If your AGI is affected, you're now impacted. So though it sounds good in theory, hey, let me deduct everything and not pay no taxes. Well, now you are limiting what you can do in at least the next 1 or 2 years to better propel you to finish your wealth building journey. So why delay if we don't have to, right? You want to be comfortable with the amount you pay. So again, this is what tax planning is for. Because outside of us projecting out your revenue and expenses to figure out how much you'll pay, we're asking, okay, well, what are your goals, right? Are we trying to get a house? Are we trying to start another business? Are we about to get married to have kids? I need to know what we are saving for because this will dictate, how much we are, attributing on our tax return. Because not to say that we don't report income or we don't report expenses if we don't need it to be higher or lower. It's we can figure out a strategy to work around it. So whether it's deferring revenues, whether it's expediting expenses, we can strategize around it, but it's all up to what your goals are.
Ooh-wee. Ladies and gentlemen, it's the People's CPA. I don't keep saying that. It's the People's CPA. Real quick before we go, because I really want to speak short, quick, simple, straight to the point so people can just get some knowledge while they're filing. For self-employed people, what is something that here we go. What are the top 3 mistakes self-employed people do during this season?
Oh, there's so many. Mistake number one is not having your books together. Let's put that out there. Not having your books together. Because and when you say books, what is that? Because you have new entrepreneurs. So when you say not having your books together, what do you mean by that? Yeah, so it's your accounting and your records. So it's 2 pieces because bookkeeping is one piece. That's understanding your numbers, his revenue, his expenses. But then record keeping is also equally as important because that's how we defend those numbers. Okay. So when I say books, it's the combination of bookkeeping and accounting. Bookkeeping, aka accounting, and record keeping. Okay. You want them to be together so you can confidently defend your tax positions. Okay. So that's mistake numero uno, is that. Ooh-wee. Numero dos is not understanding how you can better save yourself in taxes by switching your tax election, right? Okay. So a lot of entrepreneurs, we default to get an LLC, very common. With LLCs, your net income will be subject to self-employment tax, which is 15.3%, in addition to paying ordinary income tax. Yeah, it's a lot. Right. For some individuals that make, I would say, less than $40K a year, that makes sense. It may not be a huge significant change. Right. But once you are making, I would say, between $40,000 and $400,000 a year, you probably want to see if you should switch to being an S corp. In this way, because again, before we make a decision, it's understanding that you have to be able to provide payroll for yourself, right? But if you can comfortably say, hey, I netted $400,000, I paid myself $100K out of that, I got $300K left over net income. Rather than paying that additional 15.3% of taxes with an S corp, that $300K will only be subject to your ordinary income tax rate only. So similar to how dividends are taxed, since it's going to be a shareholder's payment, so it is taxed as a dividend. Yes. Yes. It can save people thousands. Thousands of dollars. Thousands. Just from one move. Just from one move. Yes. So I always make this joke, how Geico's like, you can save 15% or more by switching to car insurance. Yeah. I say you can save 15% or more by switching to S corp.
Are you an S corp? If you are a business, if is it net 40 or gross 40?
Net. Emphasis on the net.
Net. So if you make net, yeah.
40 to, I would say, 400,000 to where we can comfortably pay you some type of salary. Yes, we can save you tens of thousands of dollars just by that one move.
And net means after you sit down with a CPA, you may have made 800,000, but your company netted
exactly
400,000. Out of the 400,000, you personally profit. The company paid you 100,000.
Exactly.
Okay.
Exactly. And this is why bookkeeping is important, because we cannot make this analysis without having your books properly in order.
Man, this is why she's the people CPA. Because you need this kind of information. You need this kind of wisdom. All right.
Lastly, my third is understanding that you can deduct outside of your means sometimes. And when I say that, a lot of people think if it's not directly related to my business, I can't deduct it, right? And a more common deduction that can exemplify this is home office, right? Many individuals we're, just post-COVID, kind of, sort of.
Right.
Right? A lot of us are working from home.
Okay.
So though your apartment may not be in your business's name or your home may not be in your business's name, that can sometimes deter entrepreneurs from deducting their home office.
Yeah.
But it doesn't have to be in your business's name, because technically, if you are working from home for your business owes you rent, right? Mm-hmm. It owes you rent for using your space, right? So you can figure out a way to legally and ethically allow your business to lease from you. So now this becomes a tax deduction again. Your rent, your utilities, all that extra good stuff.
Are you serious?
I'm dead serious.
Okay, all right. Got another question for you, because you was talking to me about cars and break things down.
Yes.
You was telling me how electric is like the route to go, because you can get some extra benefits from that.
Mm-hmm.
What is that whole thing?
Yeah. Mm-hmm. So in many states, you can get a credit for having an electric vehicle. So for example, California, one of our favorite states, if you go E, you do get a really big rebate back from California State Tax Department. So you'll get a higher refund from having an electric vehicle. And again, as we spoke about in episode 1, the tax code really more so acts as an incentive on how to, have society move towards what legislation wants them to do. So we want y'all to go electric. I'm going to give y'all tax credits for going electric. And outside of the scope of the vehicle, it applies to your home as well. So if you're paying for energy efficient stuff in your home, like windows, solar. You're paying for a solar panel, you're paying for doors that insulate a lot better, or a better HVAC system. If they qualify under being, energy efficient under certain programs, you can also get credits for that as well.
Listen, y'all, it's the people CPA, my CPA, my little sister who's killing the game.
Thank you.
This woman done bought her mama a house. She's about to buy a house, and she done bought cars for her and her mama. How many businesses do you own?
I think
like 4.
I think like 4.
Yeah, like 4 businesses. I'm like, this is why she's my people, because she gets smart, she gets intelligent, but I do know that she's gonna make sure that I do it right, legally, ethically, and also for me, like spiritually as well. Mm-hmm. I want to make sure that I'm pleasing to God. So I want y'all to click the link in the show descriptions. All right. In the show descriptions, click the link in the show description. I'm going to have Ramsey Smart Tax there, to where very affordable, very good. If you're not making over 6 figures, if you don't have all those forms, great route to go. They're going to ask you a whole bunch of questions. I've used them personally several times. And then we'll put VITA down there, to where if you are struggling financially and you just don't have the funds right now, hey, I'm going to drop that link down there. That is a proven and researched link to where you can get some free help. And then I'll make sure to have my girl's information if you out there balling and you need a CPA, because I would encourage you to. What I love about what she does is what I never really had the privilege of understanding. I just thought, okay, I need to see someone around tax time. No, man, we meet once a quarter. We touch bases once a month on my bookings, and then once a quarter we analyze, okay, this is where the business is, this is where you're going. Anthony, you may have some trouble over here, so let's do this. There's a strategy that the wealthy people are putting in place, so that way they're legally paying their taxes, but they're also legally not paying as much taxes. And I think we as Black people, I'm just going to say it, we need that same strategy, that same plan as well. And so, man, thank you so much. If you missed our first show, it's 2 hours long. And it was, I mean, we talking about writing off dogs. we talking about writing off the, the G-Wagons. We're talking about how do we pay our kids and write that off and set them up to build wealth. And there's so much information. I'll also make sure to drop that video in the show description. But it's your boy, Anthony O'Neill. Sis, thank you.
Thank you for having me at the table. ATL edition.
ATL edition. We still had a table in the building. Yo, peace out. It's your boy. I'll see y'all next show. All right.